All right, so good afternoon, traders. Good afternoon. So, as evident from the slide, it's fantastic to see some regular names here. Great, welcome. All right, so once more, good afternoon. So, as evident from the slide, we are going to be looking at trading strategies. It's all about news trading today, and there's trading strategies for beginners. Now, while this is still a debated topic in terms of news trading, trading based on the economic calendar is a tactic many short-term and some swing traders employ. I'm certainly not here to say that your trading approach is better or worse than mine or another trader, but just hear me out today and then decide for yourself. Many moons ago, I fell firmly into the bucket of news time is a dangerous time to be in the market. Liquidity is thin, and I really did not want any part of it. That was, however, until I was shown how to correctly view economic indicators. And it really changed my perspective on the whole approach. So, as I said, give me a little bit of your time, maybe 30 minutes, and then decide for yourself. If you feel news trading is fit for the bin after this, then that is absolutely fine, as what works for trader A may not work for you or me. Now, by way of an introduction, my name's Aaron Hill, and I'm part of the FP Markets research team. I've been involved in the financial markets for more than a decade now. And yes, I still remain very, very passionate about this business. As usual, there should not be any issue with the sound or the slide deck, as these were double checked before going live. Do be sure to let me know, though, if there is any issues. It is fine to fire across any questions during the presentation, as long as it really relates to the slides. But if you feel something requires more of an in-depth response, maybe leave it till the end, or alternatively consider sending me an email, sending the research team an email, and we'll get back to you as soon as possible. Now, the emails will be provided at the end of this presentation. All right, so just a quick disclaimer, guys. Trade responsibly. Derivative products are highly leveraged. They carry a high level of risk, and they are not suitable for all investors. Really, look, all this really is saying is this is not investment advice. It's quite simply educational. Okay, so what this webinar is going to focus on, first and foremost, we want to understand what news trading is. I will take you through the economic calendar provided by Trading Central to ensure that you understand the components of a calendar, because that's what you'll be working with if you're trading with the news. Is news trading right for you? Hopefully by the end of this presentation, that will be a question that's answered for you, and how to create your own news trading strategy. So really what I have here today is 3 different approaches, which I have personally used, and I know of others that do use these consistently. So do stay tuned, and hopefully we'll take something from this. As I say, just to repeat, any questions missed or those that need a more detailed response, you can email me and the research team, and we'll get back to you. Also, feel free to send across any topics you wish us to cover in future webinars. All right, so I will now switch things over to the Trading Central's calendar. Just bear with me, guys, and we'll get this underway. All right, so now you should see on the screen my Trading Central. This is available to any funded clients with FP Markets, so you'll have access to the Trading Central's tools. But what you want to select is the economic insight, and that will take you directly to the calendar. Okay, so as you can see, I set this to look, I'm going to assume we're all familiar with the economic calendar, as you will need to be able to, as I said, you will need to be able to trade with this if you are intending to use economic data. Uh, what the economic calendar does in a straightforward manner is show scheduled news events, in relation to the economy and the financial markets. Now, do note that you will hear some analysts and some traders and some investors refer to news events as economic data or even risk events. Now, a risk event is really any economic event, or economic data point, or even a central bank speech that could move the market. So you can really think of them as the same thing. They are, for all intents and purposes, they are interchangeable. As you can see with the economic indicator, as you can see here, an economic indicator is data for a particular country. Here we have the UK inflation rate. That's due on Wednesday, early morning for me. And what that gives us is data for a particular country for a specific economic indicator at a specific date and time. With it, what you'll have is I hope you guys can see this, is you'll have the actual numbers, you'll also have the forecast numbers, and you'll also have the previous numbers. So you'll have three numbers. The actual number, just to be clear, will not be released until the economic data has been announced. So tomorrow morning by 7 a.m., you'll also see, so for instance here, if you're comparing these two, this is yet to be released, so you won't see the actual number, but economic indicators. So the Canadian inflation, as you can see, has actual numbers. You'll see that the inflation rate for the year-on-year for February has called to 5.2%. There's the actual number. So the previous number was 5.9%. The forecast was 5.2%. So we come directly in line for this headline inflation release. To ensure we're all on the same page then, so economic indicators are, as their name implies, are statistics, often on a macroeconomic scale, and they are designed to measure the economic activity. Traders and investors, they use these indicators to analyze the, shall we say, the well-being of a country's economy. So we have government organizations, we have private groups that release several economic indicators on a weekly, on a daily, and also on a quarterly basis, each measuring economic activity for a particular segment of the economy. Now, widely followed indicators are employment, inflation, as you can see here. This is particularly important at this juncture of where we are at the moment, and also growth data. So think of gross domestic product, which measures the economic activity within an economy. We also have things like retail sales. Very important. Things like the stock market. So do bear in mind that the stock market is a forward-looking measure. So we can use that to to help forecast where the economy is likely to be headed. So if you see the stock market turn higher, you can, within I think it's about a year, see 12 months to 18 months, believe that the economic picture will also improve. Industrial production is another one. Housing figures are very, very important as well. Now, just to be clear, that no single indicator can provide a clear picture of the economy's health. At best, really, each indicator provides a snapshot of current conditions. So, but when we piece together these economic indicators, so when we piece together inflation, the central bank forward guidance, which isn't really in play anymore at the moment, and employment data, retail sales data, housing figures, well, you should get a clearer picture of how the economy is faring. However, it's crucial to understand that some economic indicators are more important than others at certain points in time. So as I've said, inflation, as of this presentation, inflation for the US, inflation for major economies are incredibly important. Other indicators to watch can be found on the statements from central banks in their forward guidance. So this is what the central bank central banks are watching. And this is what you should be closely watching too. Now, that was, of course, until most central banks switched to a meeting by meeting approach. Now, I will talk about this briefly. So just to be clear, as a trader, the economic calendar is one of your best friends. Although you will only take it should really only take you a few minutes to look at the economic calendar and note down the events. Traders, irrespective of one's trading style, should monitor the economic calendar, as events can essentially influence a trade's outcome. Now, what I mean by this is if you say, okay, I'm primarily a technical-based trader, which is fine. But for me personally, I would always want to know where the high impact events are on that day. So what I do is I note down all the high impacting events, sometimes even the tier 2 data, which is the potentially medium impacting events. And I'm aware of when these events are going to be released. So if I'm about to take a trade and I know that a potentially high impacting event is scheduled at that point, I will probably step aside, because if I'm trading based on just a technical method, I could potentially be thrown around by the market. And I can assure you that has happened to me in the past when I was just beginning my journey, and it's not a pleasant situation to be in. Now, in terms of the calendar for Trading Central, now I assume most of us are clients with FP Markets, so you will, if you have a live account, you will have access to this as well. So for me personally, I always set my calendar to this week. So I have Monday all the way down to Friday, all the events ready and waiting for me. So I set this to this week. In terms of filters, I don't generally focus too much on the low importance. Just to give you an indication of what the low importance types of indicators are, you'll see these are shadowed with essentially no color. So you'll have no color on the calendar. For the medium impacting event, they'll be shaded in gray. For the high impacting events, they'll be shaded in red. For me personally, always medium and high. That's all I filter. That's all I want to know in terms of the economic calendar. So event type, pretty self-explanatory, guys. I won't spend too long on this, but holidays and economic events. So I want to know when major financial institutions are closed. So if the US, the UK, and things like that are closed in observance of their respective bank holidays, I do want to know about that. You can also select the G7 countries. I have selected all the G7 countries to be aware of. I've also included some other European countries as well. I include Italy and Spain as well. But other than that, that's all I really, obviously the US as well is included there, and Japan as well, and Canada, of course. So this is really all I have to say on the economic calendar. Look, I'm assuming most of us are aware of what the economic calendar is. I do have a video just dedicated to the economic calendar. If you're interested, you can find that in the archives or on the main FP Markets webpage, or alternatively, head over to our YouTube channel and you'll find it there. Now, there are some things on the economic calendar I do find new traders struggle with, and that's the terminology used from year on year, month over month, and Q4 and things like that. I do understand if you're new to the industry, this could be quite confusing. So for any new traders here, I will go over this briefly. So annual or year over year really, as you may expect, is simply data compared with data a year prior. The main ones you will get are the quarterly figures and the monthly figures. So this is in addition to the yearly figures, guys. So quarterly represents data compared with the previous quarter, and monthly is the same. It really represents monthly values compared with the previous month. Nothing more, nothing less. Now, where it does get where it does get a little bit confusing is year-on-year comparisons. What they do is they include annual, quarterly, and monthly performance. So just to be clear here, we can use the inflation rate for the pound tomorrow. So as you can see, it's for February, and that's the monthly performance. So in performance terms, of a year ago, we are measuring February's data against February's data compared with a year ago. It's not a monthly measure, hence year over year, Y over YOY. Okay. You can also simply say the same when you see the quarterly figure there, because I just saw one. There we go. Current account for Q4. Oh, that's the quarterly measure. Sorry, guys. But if you see a year over year with a Q sign there, you can just assume that we are measuring data in the measuring quarterly data compared with a year earlier. That's it. You will see a lot of Chinese data have labels like Q/Y. I can write this down. I think I can annotate on this. So you will find that you'll have these types of Q/Y. So all this really means is, and again, guys, this will be mainly for Chinese data. Now, this data represents the quarterly value compared with the same quarter a year earlier. Nothing more, nothing less. Now, another term I see some traders get confused with, especially new traders, year to date. This refers to the period extending from the beginning of the year to the present date, hence year to date. You may also see some indicators that are labeled as such, year to date. Excuse my handwriting, guys. Year to date over Y, and really all this means. And look, I do see Chinese data with this as well. And all this really tells us is the year-to-date investment or the year-to-date performance compared with the same period a year earlier. Okay. You may also see on the calendar something like 3M over Y. So what this means is the 3-month moving average compared to the same period a year earlier. That's all you need to know, really. And these can be this type of indicator can be seen with a number of different countries, including actually the UK data. So, what is news trading? So, at its simplest, news trading is the practice of formulating strategies that involves economic data. I think it's very important to understand that the excitement of trading the news usually does overwhelm a trader's sense of logic and good sense, and it can really lead you down a path of destruction in terms of your account. So be very careful with this. Now, I'm sure that for anyone who has tried to trade the economic calendar look, particularly when first starting out, found it to be an incredibly frustrating endeavor. You will, if you have not tuned into both market expectations and the economic picture, you will likely be thrown back and forth, like I have been in the past, until you or even your account balance can no longer function. Just to be aware that sometimes news trades, what they do is they take off and move in one direction. Sometimes there is what's known as a stop run first, and then a move in the opposite direction. Or sometimes there is a back and forth, like a mean reverting movement, which is usually setting up for a larger movement on a longer term horizon. Now, first and foremost, we have to understand that the market's movements is based on expectations. So the price movement is based on expectations. Really, what I mean by this is that if an expected outcome of an event, so let's say the non-farm payrolls in the US, generates an expected outcome. So similar to what we just looked at on the economic calendar with the Canadian inflation, you saw that come out as expected. So let's say we're looking at the non-farm payrolls and it generates an expected outcome. Now, the immediate aftermath, so the post-event volatility, will likely be limited, as it's printed in line with what economists expected. However, if the outcome of the event is unexpected, so let's think of that a higher than anticipated NFP print unfolded, this would therefore see a more violent reaction. Now, why do you think that is? This is simply because market participants are readjusting. They're readjusting their expectations of the market. Now, to be clear, there are a number of ways that we can trade the news and formulate strategies. Though here, as I've said already, I will focus on only a handful of what I believe to be key approaches. Ultimately, those who trade news releases attempt to profit by taking advantage of market sentiment, leading up to the release of important news or trading on the market's response to the news after the fact. Now, prior to the global inflationary phase we have witnessed, central banks offered what's known as forward guidance. This essentially, for anyone that's ever read a central bank statement, this essentially informed us what indicators to monitor alongside the central bank. So most major central banks, unfortunately, however, have now adopted a data-dependent approach. So a meeting by meeting method, as central banks really, they kept being surprised by the data, mainly the inflation data, which really affected their credibility in terms of their forward guidance. Now, an important point to remember is if you're considering trading the central bank meetings, it is not the same as trading an economic indicator, as there can be more variables to take into account. So, for example, the FOMC, which we have later this week, and the ECB both have press conferences of 45 minutes after they release the statement, and it is here, these press releases, where price action can also see some exceedingly serious chop, or whipsaws, if you will, as the press conference usually has unscripted answers from the central bank heads. So think of Jerome Powell and Christine Lagarde, which, as you can imagine, can play havoc on the currency markets and, other asset classes as well. So buy the rumor, sell the fact. I'm pretty sure 99% of us have heard of this, but may not truly understand what it means. And this is important to understand, as it serves well as an introduction. Now, just to be clear, the rumor is not inside information or anything of this kind. This is information that's known by all market participants. Really, all it means, though, is it is the anticipation of and trading of an event. As a very basic interpretation, we can think of let's think of a major central bank's decision to raise or cut rates. So the expectation of the event is widely available for all to see. On the economic calendars, you'll see that we are expecting, for the FOMC, for example, this week, we are expecting that the Fed will raise rates by 25 basis points. But look, guys, this has pulled back to some market desks, anticipating that we may actually see a pause with the FOMC. Nevertheless, the point is we do have an expectation by the economists, by major economists. So the expectation of a central bank raising their rates will generally see the country's currency advance in anticipation of that event, of the central bank meeting. And assuming the release is as expected, assuming that we do, for example, for the FOMC meeting, we do raise rates, but we do see the Fed raise rates by 25 basis points, there will generally be a pause in that buying that was seen pre-event. and maybe even see a modest correction, erasing some of the earlier gains leading up to the event. Now, why does this happen? So in the case of this example, who is left to buy? So let me just get the handy dandy pen out. So for instance, if price is here and the event is over here, we are expecting that the Fed will raise by, say, 25 basis points. What you'll see is price trading higher into that event. Okay, you'll find that price trades into that event. Now, once the event is released, and if it's in line with the market expectations, you generally see price consolidate and eventually correct. Now, again, why does this happen? Well, in the case of this example, who is left to buy the market? So collectively, bids in the market could be weak. Therefore, a down move, as you can see here, very, very briefly, you can see that a down move could materialize. So think about it like this. Those buyers who bid the market here in anticipation of the central bank hiking its policy rate were only in the trade for that specific event, for this event, for the central bank event. Once the event is released, assuming it is released as expected, a collective correction could emerge as traders cover their long positions. So they liquidate their positions. And what happens when you liquidate a buy order? It becomes a sell order. Okay, so of course there will be other traders in the market for different reasons, but for this particular event, it should now make sense why we see this buy the rumor. As you can see, the rumor is we'll get a 25 basis point increase in the Fed funds rate, and we sell the fact. And the reason we sell the fact is because of those traders that were in on this move no longer have any reason to be in this market, and hence click the liquidate market because they want to take their profits, and hence you can see a sell-off materialize. I do see a question. Just bear with me, guys. May kindly be. Okay, so look, Imran, I'm sorry if I pronounced your name incorrectly. I'll hand out the emails at the end of this session, and you're more than welcome to email the team and ask for the slides of this presentation, ask us any questions, and we'll respond to you. No worries at all. Okay, so trade into event. So the first and most obvious trading strategy is what's referred to as trading into a news event. You should really have an idea of that already, given what we've already discussed. Now, this involves assessing the expectations. This involves assessing the expectations and the economic position of the marketplace. Of the marketplace. So now, similar to buying the rumor and selling the fact, this will provide the basis for trading into a news event. Now, the expectations or the forecasts are available on most economic financial calendars, with some, and now this is quite important, with some also providing a forecast range. Now, major institutions such as Reuters and Bloomberg, what they do is they poll major banks, major economists to form a forecast range. What you usually see on the economic calendar, what we usually see on things like Trading Central, is we'll see the median expectation, which is a measure of location that locates the midpoint of a batch of data. Now, with the forecast range, you'll see the entire batch of data from the extreme high to the extreme low. Okay, I'm just going to switch things over to the trading charts, as this is an example I really wanted to show. Just bear with me a minute. Okay, you should now see the US dollar index. Any issues with the chart, do let me know. But yeah, you should see, let me just move this. You should see the US dollar index. And this is commonly referred to as the DXY. So let's focus on the US inflation situation and the FOMC. Now, just to set the context, since its peak in June last year, at 9.1%. The annual inflation rate in the US has slowed to 6% as of February of 2023. Now, the lowest since, and this is the lowest since September of 2021. And what happened was this 6%, this 6% in February actually was in line with market forecasts. Now, to add a little bit more context here, this marks the 8th consecutive fall, which for the US inflation rate, which although is pointing in the right direction, let's just be clear here, it does remain 3 times above the central bank's inflation target. Now, the inflation target is 2%, and that's pretty much across the board for most major central banks. Now, here's where it gets interesting. Now, ahead of this, so this red line here marks the US inflation rate, the previous US inflation release, and that was on March the 14th, as you can see, and that was released at 12:30 p.m. GMT time. Okay, so pre-event, look what happened pre-event. We saw a consistent downward shift, a downward bias, right? A downward trend, if you will. This is the 5-minute chart, guys, so just bear that in mind. Now, if you see remember, guys, that the inflation release actually come in line with forecast, but the inflation was, I think it was 6.4%. So it dropped from 6.4% to 6%. So the expectation was for another consecutive fall. Hence, heading into the event, we generally will see price decline. Now, with that being said, as the event took hold of the market, what happened here? Let me remove this red line. This is the event. What happened here is we saw a mild upward correction. So we saw the events. So this is literally right after the event was released. So we came in at 6% and we saw a spike to the upside. Then a small dip lower. And really what transpired then is we had a consolidation. So this is really important information here, guys. So we get the release. Prior to the release, we see a clear downtrend. We get the release and we see a mild spike to the upside, followed by a period of consolidation, and then we saw quite a major move higher to the upside. So in this case, what we had here is they sold the rumor. So traders and investors, they sold in terms of this event, they sold into the rumor. The rumor was that US inflation, a slowdown in US inflation. And what happened is they eventually bought the fact. So they took profits from this move here, heading into the event. So shorting prior to the event, we are effectively trading short based on the expectation. We're trading into the event based on the expectation that inflation will continue to slow, and importantly, consequently, the central bank will continue to slow its rate hikes. In fact, it's pretty much priced in now that the Fed will opt for another 25 basis point increase at the next meeting, though, as I've said, there were times expectations called for a pause in the rate hikes. However, it has been the consensus for some time now that given the slowdown in inflation, the FOMC is going to pull back. It has already begun to pull back on its rate increases. And this is exactly what we've been seeing, right? So the expectation of the Fed slowing the pace of policy tightening has, of course, added weight to the dollar's downside. Look at the dollar chart from the daily time frame. The dollar has been trending lower since, I think it was September. Yes, late September of 2022. Let me just get that chart back. Okay, so yes, it's been in a decline since September of 2022. And look, the expectation of the Fed slowing the pace of policy tightening, as I said, has added weight to the dollar's downside. And this is why I believe the US dollar is struggling to catch a strong bid right now. And this is because a slowdown in inflation really tells the market that the FOMC are likely to continue cutting back on their policy tightening and eventually pause. And again, this will weigh on the dollar. So the bottom line here is that in order to trade into an event, the market expectations for an event must support the economic picture for that currency. So in the case of the example with the US inflation, traders will only short the dollar, as they did here, short the dollar, will only short the dollar ahead of the lower than expected inflation release, if the market sentiment is negative and is unlikely to be modified in the near future. So given that the Fed are now expected to slow interest rate increases and eventually pause, we can expect the dollar to continue to fall, leading up to a risk event with a lower than expected data point. Now, if the economic landscape was healthier and the inflation release forecasts a slowdown, then this would be very difficult to trade into. So trading into an event, just to really wrap this up, trading into an event, you could have looked for shorting opportunities across all of this here. You could have taken the support break here. I'm just really spitballing here, but you could have taken the trend line resistances, Fibonacci retracements. You could have really honed in a technical approach, knowing that the general direction was likely to be to the downside. Assuming that the expectation remained as a lower than expected release. So trading into an event, as far as I'm aware, is really only achieved when the economic event harmonizes with the overall sentiment. Again, guys, what I mean here, we had a lower than expected increase, a lower than expected inflation release. So the expectations for the inflation release was for a slowdown, alongside the US Federal Reserve also expected to continue slowing its policy tightening. Bear with me, guys. And this is really where I look at another potential news-based strategy, which entails trading during the event, or what some may refer to as trading out of the event. Now, this is slightly different to trading into an event in the sense that we are looking for the events to be opposite. So we're looking for opposite expectations and the economic position. So what do I mean by this? I mean, so the market consensus will still be needed, as will the economic picture for the currency you are trading. So let's change things up here a little bit and look at let's start looking at. So let's change things up and say, imagine US inflation is expected to slow to say, let's say 2%. Okay, 2% in December. The current rate, let's say, is 2.5%. Okay, 2.5%. And this is the previous figure, guys, just to be clear. And here is the difference. If we are trading out of a risk event, we would need the overall economic picture, the overall market picture for the dollar to be healthy. So in this case, we could think about the Fed being expected to push up interest rates. So we're looking for the Fed to raise interest rates. Okay, push up interest rates. But on the other side of this, we can see the expectations for this economic event is for a slowdown in inflation. Now, and this is where it gets interesting. With the US inflation print expected to come out at 2%, a lower than previous number, imagine that things shift and we see a 3% upside surprise, beating both the economists' forecasts of just say that was 2%, sorry, easily beating the economist's forecast and the previous number. What would happen in this case is we could see a strong dollar bid, and this is a potentially tradable scenario. We could see a strong dollar bid, and say as the dollar increases, we could see the euro dollar and Aussie dollar sell off. In this scenario, we could even see stocks sell off and bonds take a hit as traders price in the possibility of further rate hikes occurring from the Fed. And this can provide a nice, of course, you will likely, if you're trading during the event and the event is released, then we get a 3% upside surprise, and the Fed is looking to hike rates. And the previous number for the economic event was 2.5%, say the inflation, US inflation. This would be an immediate buy for me. So I would enter the market. Yes, I may suffer some slippage, but I believe that the market will continue pushing higher. But the key point here is this is when you engage your technical understanding, because if I buy here and price is shooting up, I would then look for technical resistances to the upside. Now, this could be a combination of Fibonacci, this could be a combination of harmonics, this could be just basic resistance levels. But that's what I will be looking for to take partial profit. So profit 1, profit 2, profit 3, and I'm out. And that's how I would look at trading trading the trading out of an event. Now, there's something I do really want to touch on, and this is central bank policy divergence. A key trading principle in the FX world is trading with a strong currency against a weak currency. I'm sure we all understand that. So what we are looking for here is a policy out of one central bank to support a currency by hiking rates, or even if both central banks are slowing their pace of rate hikes, which one is slowing the fastest. Which one is slowing the fastest? The slower of the two could provide support for one currency over another. I do have a chart here that I will show quickly. And this really can be something that we can use with a swing trading approach. Essentially, what we look for is the divergences between two major central banks to find setups with our currency pairs. So on the screen very shortly, you will see the daily chart of the Euro Aussie dollar. So currently, if you, sorry guys, excuse me, bear with me a minute. If you look at the expectations for the central banks, we have the Bank of England, we have the ECB, we have the Fed, we have the Reserve Bank of New Zealand, the RBNZ, and we have the SNB. They are all still expected to hike rates out of the G10 currency space, all by 25 basis points. Now, the BOC and the RBA are now expected to remain on hold, with the latter, the RBA, having more confirmation through its meeting minutes that was released today, actually released earlier today, which said its board members were looking to pause. Now, what this does, knowing that we have the the ECB looking to hike rates, but the RBA looking to pause or potentially cut rates in the near future, we have a potential long opportunity with the Euro Aussie dollar. Now, I did not see this earlier. Price was around here when I looked at this chart. But what I'm saying here is if we look for the central bank policy divergence, of course, nothing is guaranteed in trading, but you could, technically, you could look at the Euro Aussie dollar chart and look to buy into the Euro Aussie dollar, buy the euro, and you're essentially shorting the Aussie dollar chart to try and play any uptrends, as the RBA are looking to pause and the ECB are looking to hike. So what you could have done here is look for a bounce off of quite simply a bounce off of this 50 days. I think it's a 50-day simple move, the 20-day simple moving average, excuse me, 20-day simple moving average, and also even looked at potential trend line resistance turn support alongside other support and resistances there. So the more technical confluence you have, of course, that will add weight to your trade, but you do have a fundamental backing here. That's my main point. We will be going into this in more detail at our next session in terms of swing trading, because that's our next webinar for this the series of trading strategies. Okay, so now if we're just looking for a purely technical trading strategy, look, I have done this before, and I know traders that do this. If we're looking just to trade the news purely from a technical perspective, forging a trading strategy can be difficult. While I'm not saying this is the only avenue one could explore, it is certainly one that I know is traded and has merit. Now, if we're just basing our trading strategy on just the news, relying on technical levels to trade would be difficult during the event. What I mean by this is should the US inflation data release trigger strong market movement, expecting a technical level to be respected is not something I have seen work, although surprisingly it does at times. However, what I have seen is things like this. So we have a resistance level here. Our price action is, say we're in an uptrend and we've been consolidating ahead of the event and we see a breakout to the upside. This is caused by the event. So 15 minutes, 30 minutes comes is 15 to 30 minutes following the event. We do have a pullback in play and we could potentially trade this. So we know the breakout has formed based on news, and we know this is really a liquidity push, and we're looking for this is an illiquid move, if that makes sense. And a liquid, if you look at price action in terms of liquid, and I think it's liquid, I forgot the terms now, but I know when I see a chart, if you see a one candle, a full-on a breakout candle with no interruptions, that's usually an illiquid move, and it will usually fill. So think of an illiquid move as a gap, but it's not shown on the charts because this is the FX market. And what we do is we usually see price fill that gap and retest a clear-cut resistance, turn support. So this is something I have seen done and I have used in the past. You could use, this could just be a round number. Okay, that's a very common one. You see price break out to the upside, cause a liquidity gap. Now, just to be clear here, guys, this resistance turn support could be an option for an avenue for a stop run, because what you'll have here is a decision point around this area here. So a decision point where price decided to break out to the upside. And what you'll see is, especially if this is a round number, guys, if this is, say, the 120 level on the euro dollar or something like that, you'll look, people know that you are going to try and enter long from this area, and you'll have your stops just below here. So what you'll have is the decision point. You'll have traders waiting here to buy where your stops are. So do bear that in mind. If you are trading any events, do look for the clear decision points. All right. Let me see. All right. So that's the end of this session, guys. Thank you very much for sitting with me or staying with me for the past 50 minutes. I do really appreciate it. Now, the next upcoming event for our trading webinars is Trading Strategies for Beginners Part 2, and that's swing trading, guys, and that's on the 25th of March. I'm so sorry, guys. I'm so sorry. I'll have to get the date for you, but I believe it is, there we go, 25th of April. I'm so sorry, guys. 25th of April. I need to get my eyes tested, I believe. And we'll be looking at swing trading strategies there. Again, if there are any specific topics you would like to talk about, please feel free, or questions related to this presentation, please feel free to email the either the support team at support@fpmarkets.com, or alternatively, if you prefer a more direct answer from our research team, market analyst, as you can see on the screen there, market analyst at fpmarkets.com. Now, look, guys, we do have our trading hub. FP Markets Trading Hub is packed with educational content, articles, daily analysis, weekly analysis from our in-house experts. Do pay a visit to that area. All the links should be in the chat box now. We also have a trading academy, guys. Now, for anyone that's new to trading and is looking for some clear-cut knowledge on how to begin trading, do pay a visit to our trading academy. Again, we have videos, we have articles, and all that good stuff. So please do check out the link in the chat box. For any archived, for any previous webinars, for a recording of this webinar, that will also be available through either the FP Markets webpage or the YouTube channel. You can check out all our previous webinars from all our speakers there as well. Okay, so this is pretty much, let me just check. In news trading, can we fix buy limit and sell limit on near levels? In news trading, can we fix buy limit or sell limit? So for trading out of an event, I would never fix a buy or sell limit on the near levels. Trading into an event, there will be no need really, because you'll be looking to enter at the market. Well, I would be anyway. I mean, you could use buy limit and sell limit orders if you're trading into an event, of course, because you could be buying the dip or selling the rally, depending on where you're trading. So you could use it trading into a news event, but for trading out of an event, I would always use the market execution, because you want to be in as quick as possible. I hope that answers your question there. So yeah, that's it. If there's no other questions, guys, that's pretty much all I have time for today. Thanks once again for taking the time to join us. I hope you're able to walk away slightly more informed than when you joined. On that note, have a wonderful evening, and I'll catch you all again next month, guys. Thank you so much.